So, JG, the charts are showing that US productivity is heading up, Canada is heading down. The divergence is significant. We need to talk about this.
Yeah, Patrick, it's really actually fascinating because oftentimes what happens is Canada follows suit on the US. We've seen this for many, many years. We think in Canada we control our own destiny. We often don't, not nearly as much as we think we do, because we're largely dependent on the US. But right now, it's fascinating. The consumer sentiment's a good example where the consumer sentiment in the US has really bounced back. It went from a low of 50 and now it's up to 70. We've got a great chart on this showing, and that's an example how the consumer sentiment started to come back. It kind of bottomed out in June of this year and then started rising since. Canada hasn't hit bottom yet. I think we're still going down, and that's just one example of a divergence happening. And it's the same thing with productivity. It's actually the same thing with GDP, where Canada, we are not technically in a recession right now because they revised the Q3 GDP numbers. But if they hadn't revised them, we would be in a recession. Man, GDP strong over on the other side there. Now, I'm sure there's a lot of things that are happening to drive this, but it's fascinating how we're both going in different directions right now, Canada versus the US.
Well, there's a couple things that we have to consider. Number one is the numbers and is the data that we're getting accurate? In the US side, there's lots of controversy about the data, depending on what stats you're looking at. On the Canada side, we always have problems getting data to begin with. But having said all of that, I think the data we do get, although it's lagging, it's old data, it often shows up, and we can at least trust the data that we do get, which is kind of limited. All to say this, JG, is when we look at the long-term real estate success formula, we shine a light on it all the time. And one of the things that we say is that 18 months after we start to see a softening of GDP or even going into a recession, that's when things start to show up. Now, when we consider the influencers as increasing in rates, there's a couple of things that we have to consider. Number one is that GDP started getting soft, rates started going up. We're now just coming to that point where the lag is starting to catch up, which is all to say that, are we going to hit a recession? I still don't see the indicators that are saying that, but I want to qualify it with one thing. Housing has slowed down for a lot of reasons, not the least of which is contractors, builders, developers are all touching the brake because of the cost of doing business. The numbers don't work with interest rates the way they are. So I think we have to look at that productivity. The decline in productivity is driven a lot by the fact that so much of our GDP is driven by housing.
It's funny because in the US, this is happening too. And unfortunately, we don't have a chart to show this, but I was doing some research last night. And the US has got quite a few real estate problems themselves, right, Patrick? That's happening right now because their interest rates are actually higher than ours. I mean, they're financing multifamily properties right now at 9, 10, 11, 12%. I mean, that math just doesn't work, Patrick. So there's actually a lot of trouble in the multifamily space down there. Because in the US, it's also a very different mortgage landscape. They lock in their mortgages typically for the life of that building, or sometimes 30 years. Unlike in Canada, where we can only lock in for 5, maybe 10, but who the hell would do that here in Canada? A lot of people, Patrick, if they locked in great rates in the US at 2%, 2.5%, 3% a couple of years ago, they're going to ride that wave for 30 years. Oh my God, I wish that was a possibility here in Canada. Of course, in hindsight, that would be amazing. But those people that are right now either refinancing buildings or trying to take equity out of buildings or trying to purchase buildings, those numbers just don't add up.
It's interesting what's going on in Canada on the real estate side. We've seen probably 5, 6, maybe more major bankruptcies or real estate crashes in terms of well over 100 million and excessive, like big numbers of developers and some private guys that raised a bunch of capital. We can touch on that. But the point is this, is that Canada is in a really different place with what's going on in the real estate world because the I guess, hope that real estate or interest rates are going to come down through 2024. A lot of people are trying to front run the decrease in rates. So in other words, they're telling themselves that rates are going to come down by the end of the year or before the end of the year, depending on what narrative they want to follow, but they're making decisions. I got to get in the real estate market. And what's starting to happen is we're seeing an uptick because people are going, when rates come down,
house prices are going to spike. I want to get ahead of that.
It's such a weird dynamic and psychology of how people are looking at the real estate market. And we're talking about home buyers, by the way, not real estate investors. Real estate investors, if they're staying focused and staying smart, are still finding great deals.
All right, Patrick, what a fantastic opening to episode number 32 of Rein It In. And that was just a warm-up because we got 4 fantastic sticky notes we're going to talk about. We're going to talk about what everybody's talking about today, which is some big failures that are happening in the real estate space right now and getting a lot of public attention. That's the first. The second thing, we're going to talk about productivity or the lack thereof. I'm sure you're going to go on a rant with that. I'll give you the chance. Number 3, we're going to talk about vacancy rates across the country and where they're at right now. And number 4, we're going to talk about the GTA condo market. We've talked a lot the last episode about the Alberta condo market and whether or not it's starting to turn. Let's see what's happening in the GTA condo market. More on that as we get into episode 32. So strap in, get ready. It's going to be exciting.
Let's get it done.
All right, folks, here's what we're going to do. For everybody who likes and subscribe this week, Patrick is going to do 5 push-ups for everyone who likes and subscribe. So let's jack it up. And then, Patrick, I want you to post on YouTube all the push-ups you have to do.
Okay, done. I'll even put it on Instagram because I'm into the physical challenges these days.
Like, subscribe.
Comment.
Yeah. First thing we're going to talk about today is some of the pretty public failures that are happening right now. It's all over the news. I know people have been asking me about it. I had no knowledge of this person. I didn't even know who this person was. But there's this kind of consortium or one person who had a bunch of joint ventures. There was hundreds and hundreds and hundreds of properties involved. $144 million, I think, is the total number and of real estate. And that person with the increasing interest rates cannot sustain that, Patrick. And we got some bankruptcies that are taking place. And I think this is one of the many dominoes that will fall. And we'll talk about why not more have fallen. But this one definitely fell in the last couple of weeks. This has been all over mainstream media.
What? Wow. Ooh. Oh.
We talk about it a lot, and it wasn't one person. I think there was 4, and then, of course, a whole lot of people involved in this whole thing. The game that they were playing, and listen, it works. This goes back to what we've said many times. It's all good, until the music stops, and this is what happened. So they were growing this portfolio. They're being very aggressive in terms of their strategy overall. It was good. It's not that they were doing anything out of line. They were doing lots of burrs. They were doing lots of buy low, renovate, refinance, all of those things. But here was the game that they got caught. They were doing a lot of private money to do those initial burrs. So in other words, they were borrowing money, buying the house, renovating it, then getting financing. Well, guess what? Rates went up at a record pace. They get caught going,
oh my gosh.
If I have to refinance, number 1, can I? Number 2, I can't refinance and make the math work anymore, and we can't get rid of these properties. Long story short, a lot of private money of that 144 million, a lot of it was private money, and we got caught when the music stopped because rates rose so quickly and as much as they did, and that just crushed that particular model. So in other words, it goes back to private money getting risk level interest rates, so higher rates, and they got caught.
In this case, Patrick, it's not so much because I know investors that are watching this they should be asking themselves a couple of questions, which is number 1, how do I make sure this doesn't happen to me as an investor? How do I make sure I don't, bet the farm, so to speak? And it's not, and I don't even know this person. I don't know their portfolio. I have no idea. But what I will say just in general, and this has nothing to do with these individuals, is it's not private money that's the challenge, Patrick. What it typically is typically it's the LTV, the loan to value on the real estate assets. And a lot of private money will go up to 100%, if not beyond 100%. And if I'm not mistaken, that's what's happened here is they went up to and beyond full leverage. When there's no equity in a portfolio, then there's really there's no portfolio. This is just debt here at this point. And I think that's for the real estate investor that's watching this is how do I make sure that I never get caught in that particular and put myself in that position? The answer is keep your LTV lower. Do not ever, leverage up your portfolio where you're betting the whole farm up to 100% and beyond 100%, because then you don't have any real estate assets. All you have is debt. And that's a really dangerous game to play, Patrick. And these people got caught in it. And that's what happens. It's, by the way, this is not the first time it's happened. It happens all too often. And this is the kind of thing that's going to happen as this market continues to roll through. And the reason it happened to this particular group and not others is because there's a lot of people, Patrick, that, first of all, if you're doing financing with if you have an investor-focused mortgage broker and you're using more traditional channels, you typically can't go to 100% LTV, right, Patrick? You can go to 80, you can go to 75, you can go to maybe 85, but there's going to be some equity in that portfolio, and that's your buffer, that's your safety zone. And I think a lot of real estate investors, Patrick, they look at it and they don't think of it this way. They don't think of it as a safety zone, a margin of safety for themselves. They look at it as, how little money can I put into this and how much real estate can I do? But if you are at the end of the day only saddled up with debt and you don't have any equity in the portfolio, you have nothing. You're playing a game that you're going to end up losing. And that's what's happened here.
Well, the risks got really high. We go back to, and let's get really clear on a couple of things. Aside from the fact that when you're in a boom cycle, everybody is a real estate genius. And so you're chasing yield because you see the opportunity. So investors are going,
I can get 12%, 14%, whatever the numbers are, 8%.
Depending on what that particular private lending deal is. But here's the point, JG, if we go back to, I don't remember the exact month, but in 2021, I want to say early in the third quarter, we were looking and going, first off, we didn't expect interest rates to go up as high and as fast as they did. But back in 2021, we were seeing the makings of all this starting to unfold, and nobody saw or could make that call about what interest rates are doing. And I don't even think the Bank of Canada was forewarning. I mean, gosh, they looked into the camera in 2020 and saying,
rates aren't going up. We're not even thinking about raising rates, blah, blah, blah.
We all know that story. But here's the thing. Back in 2021, within the RAIN community with our members, we were very, very clear. And I specifically said many times, things are going to get soft. This is not the time to be over leveraged. As a matter of fact, make sure you have liquidity because things are going to shift and change. And this is a way to hedge your bet. Liquidity, don't over leverage. I mean, those were really strong messages that we were sending back there. What's the message about that? Number one, we were right. Number two is that you have to look at the data and you have to look into the future of what's happening. And that's the game that we're trying to play all the time. Whereas in this case, it was being driven by emotion, being driven by greed, and nobody was looking at the data. They thought this run would last forever. We could go forever. And we've seen these cycles before. And this is a classic example of the music stopped and there was a whole bunch of chairs missing.
I'm curious to see, Patrick, and I was having conversations with other colleagues in the business this week, and there's a lot of people curious to see what's going to happen with this. I mean, it's a pretty substantial failure. $144 million around a couple individuals is a lot of real estate. This was not a REIT. This was not a fund. And by the way, there's a lot of people, Patrick, that are creating REITs and funds and mutual fund trusts around real estate in order to bail themselves out of these situations. So there's a lot of that anecdotally happening. I hear it. But what's interesting is I'm curious to see if there's going to be a regulation impact here. I mean, we sure as hell do not need more red tape in this business. But these unfortunately kind of failures attract red tape. They attract scrutiny. They attract audits. And I'm curious to see where it's going to go.
Where it's going to go is it's going to get far messier before it gets better. And that's the fundamental. There was another developer in Vancouver today, filed for bankruptcy, $95 million. There was one a couple of weeks ago, $165 million. So there's some big numbers that are starting to happen as these things come to, a conclusion based on what's happening in interest rates. But I want to just shine a light on something, which is when we go to our next segment, when we're talking about GDP, we have to consider the lag effect.
All right, Patrick, let's jump into some productivity and GDP numbers, because we know that the GDP is really the economic viability of that country, that province, that city. And that is what real estate attaches to, because GDP leads to jobs, jobs lead to population growth. And those three things power the real estate market, even though right now it's being totally influenced by interest rates, politics, lack thereof, so on and so forth. We always here at the Real Estate Investment Network and on this show get anchored to what's going on in GDP. So we've got a cool little chart here in terms of comparing GDP, whether it's a hard landing, soft landing, we'll see where that's going. But GDP and CPI, because those two things are very interesting, Patrick. As GDP is coming down, so is CPI, which is exactly what the Bank of Canada is hoping for. The question is, have they seen enough of it in order to take their foot off the brake and kind of bring interest rates down so we can get back to making, get back to good business here?
Well, it's such an interesting dilemma that the Bank of Canada faces. And ultimately, we have these challenges called, do I bring the interest rates down? But we know that if they bring interest rates down, what's going to happen? The economy is going to heat up again because housing is going to be, which is what really drives our economy right now, is housing. And they're trying to front run. People are trying to front run the possibility of rates coming down. So now the Bank of Canada has really confirmed that if we bring rates down, we know inflation is going to come up. On the other side of that equation, if they don't bring rates down or they actually threaten to increase rates, we have another problem, which is the fact that the economy will slow down dramatically even more. And keep in mind, JG, when we look at our productivity chart, our productivity isn't real. It's like, don't even use the word productivity because it's not productive. It's still a very soft economy being driven by housing, and we got lots of work to do.
Oxford Economics here is fascinating because they're predicting Q3 of 2023. They're predicting GDP that's going to be negative in Q3, negative in Q4, negative. That's 2023, which, by the way, Q3 2023, those numbers were revised up, right, Patrick? I believe, if memory serves me right. Q4 2023, Oxford Economics is predicting either flat to slightly negative GDP. And then they're definitely predicting Q1 2024, which is what we're in right now. Like, we're right in the middle of it. They're definitely predicting that one to be, again, 0 to negative. And then we start to bounce back, according to them, in Q2 of 2024, and then we start to ramp back up. What I'm curious, and I wish they would have put on their chart here, because you can see on the top of the chart, you can see how this is going to have an impact on CPI. They expect CPI will come down as the economy lands softly or doesn't, whatever the case may be. I'm curious to see if you overlapped interest rates on this chart, where interest rates would go, because now everyone's got their own opinions on where interest rates are going to go. And some people are going to say, we're not going to see any interest rate cuts until way late in 2024, if not 2025, people are saying now, Patrick.
I'm starting to think that myself. When we look at the dilemma that the Bank of Canada has, given what's going on economically, it is a very, very complex situation that we find ourselves in. And we've never found ourselves here before because there's so many global macro issues that are happening, as you know. And even with supply, when you look at what's happening in Panama, the Panama Canal, and the shutdowns and the lockdowns and boats not being able to get through. I mean, there's a lot of things that are happening, but we also don't need the inventory. So it's just this weird dynamic of where our interest rate's going to go. But I have a tendency to agree. I think that the Bank of Canada is not going to be quick to bring the rates down. As I sit here today, that's what I look at. It might be changing next month, but I think ultimately the lag in GDP, I think we're going to start to see. And we won't know this, by the way, until the second quarter of 2024. But I think the first quarter of 2024, where we are today, when we finally get the real numbers, we're going to find out that it's slowed down a lot more. We can't negate or minimize the reality of these contractors, developers, builders, the real estate industry overall slowing down. Going to be a lot of construction jobs out there. And JG, I know that you're enjoying the benefits of having access to trades given your own business. You're starting to see I can get talent. I'm not being priced out of the market. I'm actually getting applications. People that show up want to work. Is that the case? I don't want to put words in your mouth.
Yeah, no, it's number one, it is totally the case. Number two, the price of these trades is finally coming back into line. And they're competing for the business. You know, they really are. I'm hearing things like,
hey, what does this price need to be for me to get the business?
You know, I'm hearing things like,
I haven't been this slow in a decade.
There's a lot of this stuff going on right now, Patrick, and it's good because it's definitely creating some competition in the space, which is fantastic. Now, I don't think it'll last, by the way. I think it's relatively short-lived, but the projects I got going on right now, it's really good for those projects because we're able to keep the budgets low. We're able to keep the budgets in check. So I'm definitely taking advantage of it while it's here, albeit I got to tell you, I don't think it's going to last because there is a trade shortage and this is just a moment in time. I think as the economy starts to pick back up in whenever, whether it's later 2024, early 2025, whenever it does start to pick back up in general and building starts to resume, I think we're gonna be fighting for trades again. So that's kind of how I see it for my business. But I do think something is fascinating before we move on to productivity, Patrick, and that is if Q1 of 2024 is negative, we will officially be in a recession because Q4 of 2023 was definitely negative. They revised Q3 2023 to be positive, so we can't count that. But Q4 was definitely negative. Q1 2024, if it's negative, we're officially in a recession.
Yeah, and I actually see us going there now that the lag's catching up. I think there's a very, very strong chance that we will hit recessionary numbers.
All right, this goes against everything I stand for, but desperate times call for desperate measures. Lord.
All right, Patrick, let's talk business productivity. This is an interesting chart. We talked at the beginning of the show in a previous segment how Canada and the US are going in two different directions. This is a perfect example. Canada's productivity is tanking and the US is rebounding. I find this interesting. And I know you're pretty passionate about, like, this is kind of, I feel like I'm throwing you a softball here because you're pretty passionate about productivity levels. But this, I think, is a very, very interesting chart.
Well, it continues to show just exactly some of the challenges that we face in even deciding or looking at what's happening economically. I mean, when you consider that productivity is declining, which it has been, when we go back to what I've said many times, part of my frustration, even from the political side of it, because it's driven by politics, is that Canada productivity was always consumer debt driven. So we know that. Now rates have gone up. So it's no surprise that productivity is coming down. But the frustrating part of it.
So's the States, by the way. The States is also debt driven. There's no difference between them and us.
No, but they spend money on things like R&D. They have a lot more exports than we do. So when we look at what's actually driving a US economy versus Canada's economy, manufacturing in Canada has been trending down for multiple years. I don't know how many exactly, but manufacturing is trending down. What the hell? It should be trending up. Because what are we doing? We're importing more than we're exporting. Right now, the world is a freaking mess. When you look at the global macro, the wars, the supply shortages, all the things that are going on, we are a resource-driven country, yet our exports are abysmal, is probably a good word. A lot of our GDP and what we would call productivity is being driven by the immigration. So people are scratching their heads. They're pissed off. What the hell? Why have we got all this immigration? Well, there's a lot of reasons for that immigration. And if I get really offside and go, well, it's political, they're looking for voters, that could be one part of it. But the other part of it really is that's what's driving our GDP. That immigration number, by the way, is what's really supporting a lot of the growth, because when people move into a country, international students aside, when people move into a country, they set up house. It was a part of the conversation we've had many times that is also what drives some of our inflation. So it's all to say this: as real estate investors, we have to look at what are the true economic fundamentals that are driving our real estate. And so when we look at the price appreciation, it's a supply issue as part of it. It's a lending issue, which is another big part of it. It's a demand issue. It isn't everybody goes to, it's supply and demand. So where am I going with all of this? When it comes to productivity, we have to look at what is it that drives Canada's productivity. And a big part of it is consumer debt driven. And a big part of that is our housing. And guess what? Interest rates are too high. People are stressed in terms of their disposable income. Things are slowing down.
I just want to remind everyone that for every like and subscribe we get, Patrick, you have to do 5 push-ups. So now would be a good time for people to like and subscribe, and you're going to do 5 push-ups and post it live here on YouTube and on Instagram, I'm told.
I'm all in.
Now, Patrick, for real estate investors, a question they often ask themselves is, what's the vacancy rates? I'm not, I don't use vacancy rates a lot to make a lot of my decisions, so to speak. But vacancy rates for the average person is important. They're thinking about what's the vacancy rate right now. Is it trending up? Is it trending down? What's happening? Now, Canada, for many, many years, Patrick, has had really, really low vacancy rates. And that's the other thing to kind of warn people here is you never want to look at vacancy rates across the country. You even don't even want to look at vacancy rates in that particular province, because you're investing not in a province, you're investing in a region like Peterborough, Abbotsford, Calgary, Thunder Bay, Sudbury, whatever the case may be. You're investing in a region. You got to look at what's happening in that particular region. But we do have this great chart, Patrick, that goes back to 1971 with the vacancy rates all across Canada. And kind of we're looking at Canada as a whole. We're looking at Calgary. We're looking at Montreal. We're looking at Toronto. We're looking at Vancouver. And so let's get into this, because I do think it's a great chart. And it really shows you kind of over the years where vacancy rate has been and where it's at today, which is, an all-time low. But it's not the first time it's this low for many of these places. As you can see, we've been there before.
We have been there before. What's interesting about all of this, JG, is that, the headlines are about vacancy rates. I can't find this. We can't find a place to live. 25 students living in this place. We are flooding the country with immigrants. And so we know we need immigration. What we don't need is out of control immigration. And that's what's happening right now, from international students to temporary residents. I mean, it's like we've got this flood of people coming in. This was the easiest call that we've ever made. Yet it seems like not a lot of people saw this one coming. And we keep going back to fundamental. You and I talk about this from a real estate investor focused point of view, which is simply to say this: you've got a lineup of people that need a place to live. That isn't going away anytime soon. If they cut immigration in half, we still have this. So from a business point of view, we go, okay, well, we're opening up this business called rental property. Oh, good news. We have a lineup of people who want to rent it. That's the fundamental of what we need. We need the revenue side of things, because we look at, well, we can't get financing. It's the cost of housing, all the rest. Got all of that. But on the other side of it, we do have math that says you've got a lineup of people. So if you get focused, get your demographic, get the right region, look for the right deal, because there are deals out there, certainly not in the single family detached world, but some old single families that can be converted, to a duplex, for example. Lots of challenges, but also lots of opportunities in the development side of it. There's a lot of deals out there if you're willing to look for the deals. And I go back to the fundamental. Vacancy rates are going to continue to remain this way for a long time, because people are spreading out across the country looking for affordability, by the way. Aside from jobs, they're looking for affordability.
It's interesting, Patrick, because vacancy rates, as we know, a lot of investors are curious about this, but it's not just vacancy rates that investors should be concerned about and questioning and asking. It should also be rents. Where are rents going, and how strong have rents been? And again, what rents do, like, who cares what the rents do in GTA or in Toronto if you're investing in New Brunswick, for example? Like, you really got to consider that you got to look at the rents of your particular market. And this here is this is CMHC in general. So they look at the market across Canada. But in general, very, very strong rents, Patrick. As you can see from this chart, rents have always gone up, which I find very, very interesting. Now, some years, 1%, 2%, 3%, which, by the way, is still very, very good good growth. But look in the last couple of years, Patrick, 7%, 8%, over 8% in 2023. Rents have gone up. So rents are on fire, which, exacerbates these kinds of things, this chart. And I just want to say one last thing about this chart before we move on. And that is, look at most markets are the most volatile market is actually Calgary on this chart. Now, by the way, this chart doesn't show all the markets, so I'm sure there's markets that are more volatile. But it's interesting because Calgary is the real outlier here, right, Patrick? Where the vacancy rate goes really, really high, and then goes really, really low, and then goes really, really high. And it's interesting because you actually warned about this for the Calgary Edmonton condo market specifically in our last episode. I think it was episode number 31. You warned about this, and this is again a chart showing that this does happen in Alberta.
Well, 100%. And a lot of has in the past been driven by oil. And right now, oil's been very strong. We're record production in Alberta. So we can continue to see a lot of people flooding into that. And the diversity, number one, of the province now beyond oil, the quality of jobs that are there. And by the way, the market isn't humming along, or the job market in Calgary isn't humming along at this crazy pace. When you look at unemployment, I think the unemployment rate in Alberta right now is about 6.3% or something along that line. But the thing is the cost of living is lower. People are moving into that province. That's a lot of what's driving rents. And let's go back to rents a little bit. You look at the chart that shows the spike in rents. There's a couple things that we can't overstep, and that is this. Part of our CPI basket, rents and the cost of living in terms of housing. So the interest payments on housing, part of the CPI basket. Rents, part of the CPI basket. And what's driving rents? A lot of what's driving rents, aside from rising costs, by the way, which are not out of control, they're definitely up, is what? Interest rates. Landlords have to, or rental housing providers have to raise rents to accommodate the fact that interest rates are far higher. So when we look at this whole picture of what's happening on the rental side of it, we're hitting the ceiling of limitations. So rents don't go up every month. It's like they pull back, they go up, they pull back. And all to one fundamental thing. CPI, when we look at the basket of CPI, JG, and this is where the Bank of Canada, we go back to interest rates, they're pushed, because if you take out the cost of shelter out of CPI, or even get it back to where it was, our inflation is about 2.4%. That's the math.
That's fascinating, and I think you're starting to see that. We're going to see that picture play out throughout 2024. Here's another great chart, Patrick, that looks at the GTA purpose-built rental. This is average rents versus vacancy rate. So you can see average rents have come down a little bit from about $4.25 a square foot. They've come down to about $4.10 a square foot, roughly, based on this chart. And vacancy rates have ticked up a little bit. Just fascinating, Patrick, to see that this is, and we've talked about this again on the last episode, where in many places across the market, rents are just starting to hit their peak. I mean, they've gone up a lot. They've gone up a lot in the last 2 years, and they've continually been strong. But I've definitely felt it across all the markets I operate in. We've hit a peak. We've had to pull back $50 here, $100 there, so on and so forth. And as the average investor, I hope they're not thinking like, oh no, rents are going down. Rents are not going down. They've just gone up so much. They can't go up forever. We got to take a breather here. And I think you're going to see that definitely until this summer. We'll see how long it lasts.
Yeah, and there's another aspect of this. This goes back to what I said a little bit earlier, which is that rents just don't always go up forever. They pull back, they go up, they pull back. But in the case of the GTA, what you're seeing is that a lot of that rental condo market has come online. So there was a lot of completions recently. So we are starting to see, some would call it a glut of condos on the market. So that, in fact, spreads out and says, okay, now we have to compete for whatever rental market there is. And so a lot of individuals, to get things rented out, given the costs, many of these guys didn't plan on renting it out. Actually, they had planned on selling. Now it's having to rent. So they're being competitive. I want to get some money to support this so I don't have to carry the full load. So that's the competitive market of rents there.
And you can see here on this chart, folks, like in 2023, there's been, especially in the Q4, in Q4 2023, there's been a lot of construction starts. That's all going to start hitting the market. And like you said, Patrick, these are, if some of these rentals, some of these condos, if they are, and that's the thing, if the condos do get sold, they often do get sold to, not always, but often there's a good chunk of them, 25% or so, that do get sold to investors, which then end up on the rental market. Those that don't get sold, the developer hangs on to them, puts them on the rental market as well, right, Patrick? So when a tower goes up and it's got 500, 600, 700 units, I mean, you could be hitting, you could be putting 25 to 50% of those units on the rental market. This has an impact on rents. This has an impact on vacancy. So investors should look to time and consider that timing as an important part of their business.
Well, I want to keep linking us back to the confusion that the Bank of Canada faces, and that we as investors, and why anybody who's trying to forecast interest rates right now, it's all just a guess. You may as well throw a dart up against the board and see what sticks, and then pick that number, because ultimately, Bank of Canada doesn't even know what they're going to do. When we go back to this particular market, which is going to be interesting, so let's just put a stamp on this one. You've got this kind of a lot of completions coming onto the market in the condo market. You've got interest rates that are high, so developers have said, nope, I'm touching the brake. I can't make these deals pencil. They don't make sense. You've got a lot of developers and right now that are actually trying to they're giving incentives. They're not blowing it out price-wise, but they're giving a lot of incentives, lots of value adds to any given project. But here's the thing. They've quit building. They want to get rid of this inventory that they've got so that they can get financing, so that they got cash flow. So the lag of this is going to be this. They've quit building, and then you're going to see a shortage probably in 2 years' time. So this will, by the way, for those who foresee the future, what this is going to do and anticipate that kind of theory to be true, if you will, that thesis to be true, a lot of people are going to start getting into what? The pre-built construction world again, anticipating that in 2, 3, 4, 5 years, that market's going to recover. So it's just a game that you have to really stretch mentally and look at the economic data and see into the future. But this literally could lead to a huge shortage in a couple of years from now because of the immigration, the slowdown in building. Once this inventory gets cleaned up, game changer.
Patrick, you're going to be a genius once again with that prediction. That's a Patrick prediction there, folks. So remember that one. Last chart on rents, Patrick, before we move on, is this one here. You could see all the major markets across Canada, from Vancouver to Edmonton to Calgary to Toronto, Ottawa, Montreal, and Canada as a whole. How much this is 2-bedroom purpose-built apartments. How much they went up. First of all, notice how much they went up in October in 2022, October of 2022, and then notice how much on top of that, how much they went up in October of 2023. And the outsized performer there is obviously Calgary, but every single market, Patrick, across the country has been on absolute fire from that perspective. And that's a big reason for that is because how unaffordable it's become to purchase. People have to rent. They don't even have a choice anymore. And that's important. In fact, anecdotal discussion, I was talking to someone just yesterday about a rent-to-own program. And they were saying, listen, I crunched the numbers. And if I bought this property here, I would actually save $600 to $800 per month compared to my rent, and I would own it. Just imagine that, right, Patrick? I mean, that's the reality of what's out there. And again, that's the challenge and the difficult part the Bank of Canada has put themselves into is a lot of people want to get back into that purchasing mindset. And as they start to lower those rates, there's going to be a slingshot effect in the real estate market, I believe, and it'll be interesting to see how when it rolls out, not if, but when it rolls out.
Well, there's a fundamental here that JG, we have beat this drum to death. I mean, I don't know, like for the past 3 years, for sure, 2 years, 4 years, I don't know, I've lost track. As real estate investors, we have to get out of the fray, the headlines. They're speaking to first-time or next-time home buyers, the retail market. We have to look at it through a set of investor eyes, if you will. And so we go back, we've been talking about rents will continue to rise, will continue to go up. Don't let the interest rates, the financing, don't let it stop you. Yes, it's harder. Got it, 100%. I'm not suggesting for a moment that it's easier. But when we look at the model of saying, why does real estate work? It works and it continues to work. Number one, there's deals out there. Number two, there is cash flow opportunities, but you have to dig for it. And what we do know is that rents will continue to tick up, given what we've got going on with the actual demand side of the equation. And ultimately, rates, even if they don't come down, they'll stay the same. This is getting normalized, and that's fine. Everything will normalize to this if rates don't come down.
Well, what's interesting, Patrick, and that's a very interesting point, talking about the normalization. We talked about that a couple episodes ago. But what I find fascinating here is there are many investors, hopefully none that watch this show. Hopefully everyone watching this show are taking action, moving their feet, crunching the numbers. But a lot of investors, Patrick, have just put up their hands and said, listen, the numbers don't work anymore. And they've stopped running the numbers. They just assume they don't work anymore. Oh, I can't make anything work at these interest rates. That's not necessarily true. I've showed you many times, Patrick, several deals I've done in the last couple months where the numbers are better than they've been in a long time. They're better right now at these interest rates. Imagine when interest rates starts to come down, they're only going to get even better and better and better. But that's only if you get in now, because as interest rates come down, the price of real estate is going to go up, back up to some other numbers, and that's going to make the numbers different again. The point I'm making there, Patrick, is a lot of people have thrown up their hands and they've made the wrong assumption, and the assumption is nothing works anymore. And that is not true. We've seen a lot of fantastic deals. So we urge people to stay in the game is the bottom line.
Well, let's go back to something. We don't sell real estate. We're looking at supporting investors to grow a portfolio, to look at future, financial gains. And if you're pragmatic, if you have the knowledge, if you have the understanding, it is in amongst this chaos that there is the opportunity. And psychologically, it's tough, JG. I look at how much research that I'm doing, how much negative stuff I'm looking at. It's really hard to get out of the fray. It's hard to get out of the mindset that the world's coming to an end, especially when you're looking at the global macro. These are the opportunities to stay pragmatic, stay systematic. We're not selling real estate. We're actually looking and saying, this is still an opportunity for you to gain the education, look at the data, make good decisions, and grow that financial future, given what's going on in the world. As a matter of fact, if you're sitting on the sidelines, what are you doing with capital? How are you putting it to work? This is an opportunity. You just have to engage.
Folks, hopefully you've enjoyed this episode 32 of Rein It In. Don't forget to like and subscribe. For every person that likes and subscribe, Patrick's going to do 5 push-ups and post it on YouTube and on Instagram. So now's the time. I know you've probably been thinking about liking and subscribing for a while. Just do it now so we can get Patrick doing push-ups. Yeah?
JG, I'm going to be really bummed out if I don't have any push-ups to do.
Don't worry. We'll make sure you have push-ups. I got people here in the office that are going to go like and subscribe just to see you do push-ups.
And JG, just a reminder before we totally sign off, this month, February, we've got a great meeting coming up. We're going to be talking about multifamily. Why, where, when, US, Canada, what the heck should we do? Ray Ostrander, total expert in that field, is going to be there to talk about it, as well as Mark Desermeaux, economist with Desjardins, is coming in. Give us an update of what's going on economically, so you don't have to listen to JG and I all the time about what's going on economically. So make sure you're at that meeting. It's going to be a great one. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.